The P ratio does not give us an insight to the company cash flow. So because of the deficiency of the PE ratio, that gave birth to what is called the PEG ratio, which is price to any growth ratio. And what does price to any growth ratio taught us? It's simply your PE ratio divided by any growth rate. Price any ratio versus price to any growth ratio. These two terms are used as metrics for stock valuation. You know, when you are buying a stock or a shares of any company, you must know if the stock you are buying is overvalued stock or an undervalued stock. And what is going to tell you if the stock is an overvalued stock or an undervalued stock is your price to any ratio or your price to any growth ratio. And when you talk about the PE ratio, which is price to any ratio, is the ratio of the company's share price to that of company's earning per share. What do I mean? Look at the board. When you are defining your price to any ratio, is the share price. How much are they selling the shares of a company? You divide it by any per share. And this is EPS. This any per share means how much profit a company generates from the outstanding shares of a company. That is, if I have a shares of a company, maybe I have 30 units of a particular company shares, then how much of the unit will generate for me as a profit is my EPS, which is any per share. Now, one thing about P ratio is this: the P ratio is used to compare the stocks of the company of the same industry. Now, when you talk about industry here, industry simply means a group of firm or company producing similar goods or rendering similar service. In case of the example I want to use, I'm using the banking sector. And I'm using the banking sector, I want to use what we call, we have what is called Fugas. Fugas are part of Tier 1 Bank in Nigeria. F is stand for First Bank, the UBA, the GTCO, the Access, the Senate. And look at the respective PE ratio here. The PE ratio of the First Bank is 1.9x. The UBA is 2.09x. GTCO is 3.5x. Access is 1.6x. The Zenith is 2.2x. Of the ratio I've written on the board now, the lowest there is the Access, which is 1.6x. So by so doing, here now, Access is having the lowest PE ratio, meaning that it's the cheapest among the banking sector here presently, based on the current PE ratio. And now, when you look at industry's average, that is, we have a benchmark for all the PE ratio of the banking sector in Nigeria, which is 6.2x. And when you look at the one of the Access, which is 1.6x, is still remain the cheapest because it's lower than industry average. Now, let's look at the example of a UBA. How much does the UBA share close at the time of shooting this video? It closed at 48 naira. Then this is the earning per share, which is 23.02. This is obtained from the statement of operation. And when you divide this by this, you have 2.09x, which is lower than the industry average. Since it's lower than industry average, we can say that the UBA stock is an undervalued stock. Now, don't forget, one thing about the P ratios is this: the P ratio does not factor in the debt of the company. One, the P ratio does not give us an insight to the company cash flow. So because of the deficiency of the P ratio, that gave birth to what is called the PEG ratio, which is price to any growth ratio. And what does price to any growth ratio taught us? It's simply your PE ratio divided by any growth rates. Now, let's continue. The PE ratio that we have calculated for the UBA is 2.09x, while the any growth rate is 11.6. When you divide that, you have 0.17. Now, look at it. According to the rule of thumb, when your PEG ratio, when this is 1, when this is less than 1, I mean greater than 1, when this is less than 1, there's interpretation for each of these. If you do your calculation for the PEG ratio and your answer is 1, we are going to say the stock is barely valued. When your answer is greater than 1, it is grossly overvalued. That is, it's too expensive compared to the growth potential of the company. And like what we have for UBA now, 0.17, which is less than 1. Because the PEG ratio of the UBA is less than 1, we come to conclusion based on the rule of thumb that the stock of the UBA is grossly undervalued. You paying 48 naira presently for the UBA bank share, it means that you are buying it very cheap compared to the growth potential of the company, because the PEG ratio is going to look at the growth expectation of the company. If factor in the growth expectation of the company, the debt of the company is included in the PEG ratio, which is not the same with the P ratio. The P ratio will not factor in the debt of the company. It will not even give you the insight to the cash flow of the company. Now, look, I've seen cases where somebody will just be telling me. Sometimes I receive a call one-on-one, I meet people, they'll just be telling me, bros, the share price of they can just make mention. Okay, even apart from that, let's just look at it. Let's look at what we have on the board. And the first bank is around 32 naira. UBA is 48. GTCO is about 95, 96. While Access is 27, 28 naira. Then the Senate close at 70 naira today. Now, you cannot tell me now, you cannot use it to judge that because GTCO is about 90 something naira, therefore it's more expensive than Senate, which is 70 naira. You can't tell me that, because you cannot use the price at which they are selling each of the stock to actually evaluate whether the stock is expensive or not. Let me give you a good example of what I'm talking about. Look at it. And Presco, the share price of a Presco is 1,480. Let's look at another company called ICO, which is insurance company. The share price of ICO insurance, I think, is 4 naira or maybe 3 naira, 60 kobo or 90 kobo. Now look at it. Somebody will believe that because this one is 4 naira now, it's cheaper compared to this one, which is 1,480. But you are wrong. Why do I say you are wrong? When you look at the PEG ratio, the PEG ratio of the Presco is less than 1, which means Presco is grossly an undervalued stock. So you buy Presco at the rate of 1,480 naira. It's even more cheaper when you look at the growth potential of that very company compared to ICO. ICO now is 4 naira, for example. Now, if you look at the PEG ratio, as of the time of shooting this video, the PEG ratio of ICO insurance is minus 0.45, negative sign, which means presently the company is unprofitable presently, because there is no growth potential in that company. That is why you see that the PEG ratio is carrying negative sign, which means the earning per share is negative. When you check their status of operation, is negative. And that is why you see sometimes there are some stocks I use for dating. I date a stock, I marry a stock. When I'm dating a stock, it means I'm actually trading such a stock. It's for a short-term period. But when I'm marrying a stock, I'm doing what is called investing. If I'm buying Presco, for example, it's for long-term investments. So, but if I'm buying high-cost insurance, I will only use it for dating. Why I'm using it for dating? Because I will trade the stocks. Because the growth potential of Presco is far higher compared to growth potential of ICO. Therefore, you cannot just look at the price of a stock in the Nigerian stock market just because some stocks are very cheap, probably because they are penny stock. Then you just come to conclusion that those ones are cheap. See, the fact that a stock is selling for 1 naira does not mean it is cheaper than a stock that is selling for 10 naira or 50 naira or 100 naira. So you should be able to understand these two concepts: the price to earning ratio and the price to earning growth ratio. But me, I mostly rely, because of the deficiency of the P ratio, I rely mostly on the PEG ratio, because the PEG ratio is going to give you the insight to the growth potential, the growth expectation of the company. So when you are buying a stock, it is better you rely more on the PEG ratio rather than the P ratio. Until we meet again, have a nice day. Thank you.